Welcome. I'm Rachel Ivanovich here with Vince Stefano and Greg Carroll, where we are here to provide you with our weekly insights on the markets, tax planning, and financial planning. And this week, Catherine and Steve are gone, so you get the Three Musketeers. And to take it away, we've got Vince Stefano.
A musketeer. I want to be D'Artagnan.
Weren't we just talking about what was his name from Princess Bride?
Yeah. Anyway.
Inigo Montoya.
Anyway, all right. Anyway, we'll talk a little bit about the markets. This has been a tough week. As I said last week, markets are kind of in a doldrum. S&P year-to-date is up about 8.7%. That's relatively flat from where it was, earlier this week. Dow up 5.6% for the year. That's pretty flat for the week. Our Russell 2000 up 1.8%. That's relatively flat for the week. And the only index that's really down is the NASDAQ, which is up 9.6% for the year, but down 3% for the week. A lot of that's technology stocks, as you can imagine. So this week, like I said, it's lethargic. Everybody's waiting for tomorrow. We've got the big Fed speak coming from Jackson Hole. The tape is getting kind of tired right now because, the big leadership group was mega cap stocks, and they haven't been acting well this week or even in the last couple of weeks. So, they've made a big sprint forward since April, and they are really holding the market back right now. And again, this was really the last big week for earnings. A number of the S&P retail companies reported, and they were mixed. And one of the biggest retailers in the United States, located in Bentonville, Arkansas, reported this morning. Stock is down. Earnings were okay, but their margins are getting squeezed because they're saying that the prices are going up because of tariffs, and they're not passing those prices on to the consumer. So again, retailers are struggling yet. And a lot of smaller retailers have really struggled. I think there's only been one or two that I've seen that have actually done quite well, and that's because they had sold off so much recently that even a bad report looked like a good report. So struggling on the retail side. I want to talk, we talked a little bit about small cap stocks last week. I want to talk about small stocks, but I'll let my colleagues kind of talk about what they want to mention today and come back to me for a little update on some small stocks. So, because I think that's going to be real interesting. Oh, and the other thing, well, I'll wait until I get into my small cap speech.
I think one of the reasons the market has been, a couple of reasons it's really been flat this last week. They're waiting for the Jackson Hole speech tomorrow from Jay Powell, see what he says. I don't think he's going to say anything about whether he's going to raise or lower rates next, in a couple of weeks in September, middle of September. I was looking at he has a speech he's given. It's called Labor Markets in Transition, Demographic, Productivity, and Macroeconomic Policy.
That's a mouthful.
That's going to put most people to sleep, I think. But I don't think it's really going to, he's probably going to do everything he can do to avoid giving an impression of what he's going to do in a few weeks for the Fed meeting. But the markets, since April, how much are they up, Vince? Like the NASDAQ's up like 40%?
40% plus.
S&P's up 30-ish,
25, 30%.
Yeah. They've come a long ways in a short period of time. So a lot of reasons the market just needs to take a little bit of a breather, get some data out. And then there's a big earnings report next week for another big semiconductor name, right?
Yes, there is.
So, there's a lot of reasons the market probably just needs a little more information to see what the next move is, up or down.
So this week, I don't know about you, but the kids were back to school and the streets were full of cars when I left my house. It took me an extra 15 minutes to get to work. So I wanted to talk a little bit about back to school financial planning for the fall. And I know this is, the time of year where the kids want the new school clothes and they want the new backpack, and it's always exciting. But it's also a good time to, work with them on lessons, like what is it actually essential and what's desirable. So it's never too early to teach your kids about money or your grandkids. So some of the ideas that we've talked about is creating a back-to-school budget. before you go out and shop and say, okay, this is how much we're actually going to spend versus just going out there and kind of free for all with your money. But it's also important to be planning for hidden costs because things arise throughout the year that you may not be even thinking about at the beginning of the year, such as field trips, sports gear, tech needs, and that can get really expensive. But then there are also the extracurricular activities that you need to be planning for. Activity fees, that equipment, uniforms are expensive, and maybe travel expenses if your child or teen is in a travel team. So definitely a good idea. And, do this together with your teens. I think that would be a great idea, or even with your younger kids. And maybe even take an inventory first before you start shopping, because you may have items in your home already that you don't need to replace. So I think it's never too late to teach those lessons.
I remember when our kids were younger and we were getting into the weekend stuff where you're going to be gone doing the sports, whatever, traveling.
Yeah.
And, it was almost like, oh my gosh, this
So
costs so
expensive.
much. I almost didn't want to tell the kids how much it cost because they might
Yeah.
get a little discouraged about it. Wow, life is really, really expensive. But it is, I like what you're talking about as far as setting a budget when you're going out shopping and knowing exactly how much you're going to spend. And they can help, pick things out, what they need or desire. And
Absolutely.
That's very good.
Because it's not just school supplies. I mean, think about it. It's the clothing, school supplies and clothing is typically what people go out and buy. But what about laptop, software? Then there's, if they're in private school, tuition and fees, transportation. Teens want fancy cars.
Well, it was kind of interesting you talked about clothing because a lot of the retailers did not see a strong back-to-school buying this year.
Interesting.
And that's why some of these retailers have not performed very well in this latter period of, mid-July through the end of August.
So back to small stocks.
Yeah. So there you go. I mean, we're talking about retailers, and I'm going to go now into my little address of small stocks. Steve and I were talking about small stocks last week, and the stock market has been in a solid uptrend. Even with worries about trade wars, inflation, recession. And with that, small cap stocks have not performed as well as you saw by the Russell 2000, only being up 1.8% for the year. And it's kind of interesting. I was, reading some stuff from Jefferies and Company, which is an institutional research and banking firm out of New York City. And they were saying that the market value, and this I found incredibly interesting, the market value of the 5 biggest companies in the market-weighted S&P 500 is more than 5 times the aggregate market value of the Russell 2000. Think about that.
Wow.
5 companies are bigger than the 2,000 smallest companies
But
in
you
the
said
United States.
5 times bigger, right?
5 times bigger.
Because I believe the number one largest company on the planet is bigger than the Russell 2000. In market cap.
And I'm saying it's
Alone.
5.
Yeah.
5 times.
That's
5
crazy.
That's
times
crazy.
bigger.
Yeah. Then
And
Yeah.
you can see where the big money flows. Money always flows to liquidity, and these companies have huge amounts of liquidity. So when big macro funds want to invest quickly, they go to these liquid companies.
Yeah.
Also, what was interesting, and a lot of people have been talking about moving money back into small caps. I like small cap stocks, and I've made money in small cap stocks over the years, but currently, less than 4% of the total value of the U.S. equity market is small cap stocks, where historically that's about 7.5%. So you can see there's a big underinvestment in small caps. And again, this article of Jefferies was talking about a lot of it has to do with the underperformance the last few years. We've all seen small caps underperform. And if you look at the past 10 years, annualized rates of return for small cap stocks, including dividends, up 6.6%.
wow.
That trails large cap by 7.3% on an annualized basis. And as a tax person who knows the compounding of money, that is a lot of dinero that you're leaving on the deck by not investing in the larger cap brethren. So, what does that mean? Well, I think part of it is small caps their earnings have not been that great over the past, 5 to 6 years. And 30% of the small cap universe has underperformed because of negative earnings. So that's a huge amount.
They're not making any
They're
money.
not making any money.
Yeah.
People, investors are looking for money. They want companies that have good free cash flow. They want companies that have good revenue, good earnings streams. And so they're moving to the larger caps. Now, a lot of analysts that follow small caps are saying, wait a minute, we're going to have a catch up and earnings are going to accelerate. I don't know about that. And I've been saying for a long time on this podcast, the way small caps really outperform is when the Fed cuts interest rates. And we really need to see about a 1.5% to 2% cut in interest rates for small caps to actually start showing
That's a lot of cutting.
That's a lot of cutting.
Wow.
But we need to see that so that small caps can really start showing forward earnings momentum. And we haven't seen that yet. And I noticed that last week, Friday, the anticipated percentage to cut that for a rate cut was 95%. Okay. Now it's at 71%.
71 for
71
September
for
17th.
tomorrow for September rate cut.
Boy.
Oh, I thought it was still higher.
No.
Yeah, I thought
It
so
just
too.
it just dropped today to 71%.
Wow.
Now, and there have been a lot of Fed governors coming out saying we don't need to cut rates. We don't need to cut rates. I don't know what Powell's going to say tomorrow.
There was only 2 dissenters last meeting.
Mm-hmm.
And that's the first time they've had 2 dissenters since like 1983.
Now, I don't know if those dissenters have changed their tune because I forgot who they were. But
Is it Waller and Bowman or something like that? Anyway,
yeah, all I know is I noticed that there were a number of Fed governors that said we shouldn't cut. And again, I think that's why this rate cut has dropped to a 71 chance of having a cut. So, where does that leave the small cap marketplace? Well, it kind of leaves it in a little bit of limbo. And so again, I think that if you want to be in small caps, you really have to do a lot of homework. You have to do a lot of stock picking in the small cap space, and you have to stay with some of the small caps that may have a real unique service or product where they could grow nicely over the next 12 to 18 months. But to be honest with you, if you're really looking to make a good amount of money in the big casino, you want to stay with the larger cap stocks, whether they be in technology, healthcare, retailers. Stay there because they've got the free cash flow, they've got the revenue, they've got incredible innovation, they've got high barriers to entry. And what they may do is, as these small cap stocks continue to languish, they may decide to go in and buy some of them and enhance their portfolio. So, be careful with small caps right now. If you're contrarian, it's a great time to buy it, but be
patient.
You may have to be very, very patient on that.
Yeah. So I had a call with a client of mine yesterday, and he was talking about the One Big Beautiful Bill Act, and we were talking about Social Security, and this bill obviously has a lot of different ramifications, but he was talking about Social Security, and so I'm like, I should look into that again and talk with Rachel today, but he was under the assumption that Social Security is not going to be taxed.
That's because they had so many versions of the bill before it was actually final.
Right. And what I was reading is that you up to 90% of seniors over 65 may not have to pay taxes on their Social Security, but that's because
So that's very misleading.
It's because they're reducing their income to get to that. And so 90% is,
So we're back to AGI, adjusted gross
Yes.
income, and taxable income. So let's just go there because it's technically the Social Security isn't tax-free. It's overall your taxable income smaller. So whatever portion of your income you can decide, you could say, well, my interest is tax-free. It's just overall the taxable income's smaller. And so let's talk a little bit about that new senior tax deduction for individuals age 65 and older. because there's a lot of confusion around this. And so it's an additional deduction of $6,000 per eligible individual, so, and it's $12,000 total if you're married. If you file jointly, if you file separately, I don't think you qualify. The duration of this is it's effective only for tax years 2025 through 2028. And then you have to have a valid Social Security number. So I think what that means is if you have an ITIN or an individual tax ID number, you don't qualify, which some individuals do have. And again, if you're married, you must file joint return. You can't file separately. And kind of the big thing that I think people aren't expecting is that this deduction phases out for taxpayers with modified adjusted gross income that's over $75,000 for single filers, and for anyone joint filers over $150,000.
So that 150 takes in all kinds of investment income,
Oh, absolutely.
dividend
Yeah.
income.
Yes.
Tax-free income, muni bond
85
income gets
85
counted.
Part of that.
Yes.
Everything is part of that 150.
85% of your Social Security. I mean, it counts all of your income. So it becomes even more important to be working with your financial advisor and your tax advisor at this point to ensure that your modified adjusted gross income is below the threshold for you to qualify for the extra $6,000. And so qualified charitable distributions are going to become a great tool for people to be able to exclude some of their individual retirement arrangement distributions from their income. So there are methods to get your income down. You need to work with your advisors.
But it's not in the bill, it's not an elimination
Correct.
of tax on Social Security.
Correct.
It's just,
It's a deduction.
it's a deduction.
I think it's
so,
actually
yeah.
technically, if you read the code, it's called an exemption. Which because what you have to keep in mind is you can itemize your deductions, or you can take the standard deduction, and this is on top of that. It's an
Okay.
additional $6,000. So just work with your advisors. That's my biggest push, and understand your tax brackets, and understand, because as I've been telling clients this last week, is don't let your tax bracket go to waste. So most people may know that the tax system is a progressive tax system. So it's not, you jump from the 10% bracket to the 12 and all of your income's taxed at the 12% bracket, or you jump from the 12 to the 22% bracket and all of it. It's not a flat tax, it's progressive. So the first 10%, or the first dollar amount is up to 10%, and then it's kind of like a stairs as you go up. And so for single filers, let's just say if you're in the 24% bracket, your taxable income's anywhere from $103,000 to $197,000. So if you're at $150,000, you've got about $50,000 that you can play with before you jump up to 32%. And so this might be a good time to be considering Roth conversions and other tax planning strategies. So definitely work with your advisors, because you really, I think starting with tax brackets is a concept that a lot of people don't quite understand.
Yeah, I've been starting to have some conversations like that too. It's like, don't let a tax bracket go to waste.
Yes.
If you're in the 22, fill it up. If you're in the 24, fill it up.
Well, and it's a big jump from the 24% bracket to 32.
To 32, that's a
and
big
so
one.
that's, if you still have some room in that 24% bracket, you might as well use it.
And what's the top of that 24% bracket for a joint filer?
For a joint filer, it's $394,600.
Almost 400,000.
Yeah.
So yeah.
And then it jumps to 32, and that goes up to 501. So
Yeah.
yeah, but I mean, 24 to 32 is significant.
Yep. It's good information.
No, it is. I'm going to have to start sending
Planning.
more money to charity. Do you still get the dollar-to-dollar write-off?
Yes. So
You do?
Yes.
So if you contribute $20,000, you can take $20,000 off your taxes.
Yes, off your taxable income.
Yeah.
It's not dollar for dollar tax.
No,
so
but if you donate $20,000 to the Cancer Society,
then your taxable income goes down dollar for dollar.
yeah,
but
that's what I thought.
Yeah.
Okay.
So
Well,
if
there
you're
you
in
go.
the 32% bracket and you give that's what your tax savings would be 32% of $20,000.
No, the charities are going to make out nicely.
Yes, I think so too.
Yeah. They should.
Not bad.
Yeah.
So, anything else for this week?
It's we're getting to the end of August, and it's seasonally a slow period. And, we're kind of looking into September, which is notoriously a poor month for stocks. We'll talk about that as we get closer and on into September.
When you say poor month, what does that mean?
It means that typically the indices are down in the month of September.
And how much?
Anywhere between 3 and 5%. Not much, but enough that some people all of a sudden get a little freaky when they start seeing the markets going down.
Right.
But
it's not something to necessarily change your whole investment
No,
philosophy
absolutely
or
not.
process. You just want to be aware of it.
It's an absolute buying opportunity.
Absolutely.
I mean, I think anytime the market's dipping 3 to 5% right now, you got to take advantage of it. And why is the market? September is a notoriously poor market. We kind of mentioned is because mutual funds close their books, they do all their tax loss selling, and oftentimes it has an effect on especially the technology names where they've had a big run, or some of the smaller cap names that haven't. So again, I think that you got to be careful, and right now there's not a lot of volume. We're kind of in the summer doldrums, and it's seasonal. The market is seasonal. So I say if you've got a portfolio where you've got 10, 15% cash sitting around, you don't need to put it to work right now. I would wait and see what happens over the next 3 weeks and on into September. And if you start seeing the market come down, and especially some of the bigger mega cap names, if they start coming down because of mutual fund adjustments, I would take big time advantage of that and start backing up the truck and just start buying them, because again, when in big multi-hundred billion dollar institutional investors want to be in the market, they're going to those names, and those names are going to start running again, and like scalded dogs.
Okay.
And if you want to know more about the One Big Beautiful Bill Act, we will be recording a webinar next week on the 26th. At noon, I believe. So keep your eyes open for that. We would love to have you tune in and invite your friends. Unless you have anything else for this week, I say we call it a wrap.
I think that's
Greg, do you have anything
good idea.
else?
I think that I have nothing else to share right now.
All right. Well, thank you for joining us today, and look forward to seeing you next week.
Thanks all.
Bye now.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.